Think about walking into an airport to catch a flight. The display screen says Gate 3 at 3 p.m. But when you get there, the local notice board says the flight is actually departing from Gate 8 at 6:30. The display screen is the plan, but the notice board is the physical reality. This chart shows that same split happening in the global oil market right now. The bottom line is the paper price on Wall Street, trading at $107. The top line is the price for actual physical oil, which has hit $130. That is a $23 gap. In a normal year, that gap is less than $2. Even during the peak of the 2008 financial crisis, the difference was only $5. Today's divergence is on a scale we haven't seen in modern trading history. We are looking at the exact same barrel of crude oil, but depending on whether you are holding a digital contract or a physical tanker, the market is giving you two completely different valuations. This split suggests the financial markets and the physical economy are no longer operating in the same reality, and for most people, their wealth is trapped right in the middle of that fracture. On Wall Street, speculators are selling contracts at $107 with zero intention of ever taking delivery of actual oil. They are betting entirely that a ceasefire will drive prices down so they can buy those contracts back for a profit. The trap snaps shut on expiration day. That's when the exchange asks sellers if they can actually deliver the physical goods. If they can't, they have to go out and find that oil, no matter the cost. When hundreds of sellers realize they are short on physical oil, they scramble to buy back their contracts all at once. This creates a market stampede, driving the paper price upward toward the physical price in a matter of hours. Learning to navigate these technical market traps is essential for protecting your portfolio. To see how we manage these risks, join the SFA Free Stock Investment Masterclass at the link in the description. This isn't just a problem for traders. This market correction is the trigger for a price shock that hits consumer wallets almost immediately. The first wave of impact is already hitting import-reliant countries. The Philippines recently declared a state of energy emergency as diesel prices jumped 41%, stripping a massive portion of the average family's monthly income. In Singapore, rising costs for marine fuel are driving up ocean freight rates. Because energy is required for every step of logistics, those higher costs are eventually passed down into the price of every consumer good you buy. To hide the severity of this shock in the U.S., the government has been releasing oil from the Strategic Petroleum Reserve at an unprecedented pace, recently reaching levels not seen in 40 years. This data visualization shows the math of the drain. The U.S. is releasing 4.4 million barrels a day from the reserve, but it's only being replenished at a rate of 785,000. We are using our buffer 6 times faster than we can replace it. This is the visible blade of the crisis, a direct transfer of wealth from your bank account to energy producers and shipping companies. But there is a second, invisible threat. Rising physical prices force central banks into a corner, making it nearly impossible for them to cut interest rates without fueling more inflation. We saw this tension in the recent Federal Reserve meeting. There were 4 dissenting votes against the interest rate decision, the most since 1992, signaling that the era of expected rate cuts may be over. Analysts are now focused on a specific number, 4.8%. That is the yield threshold on the 10 U.S. Treasury that experts warn could trigger a self-reinforcing debt cycle. In this cycle, higher interest rates make the national debt more expensive to service. This eats up the federal budget, forcing more borrowing, which in turn drives interest rates even higher. You won't feel this blade at the gas station, but it slashes your wealth by permanently raising the cost of your mortgage, your auto loans, and your future purchasing power. We have seen this exact sequence before. In 1973, an oil shock sent crude prices from $3 to $11 in just 6 months, leading the U.S. into a decade-long struggle with inflation. It took Chairman Paul Volcker aggressively raising interest rates to extreme levels to finally break that inflation, but it came at the cost of a stagnant economy. During that time, middle-class wages rose by 79%. That sounds good, until you realize house prices rose by 117%. Even though people were earning more, they were actually falling behind. The true danger of stagflation is that it feels like you're making progress, while the math ensures your standard of living is slowly eroding. Protecting yourself against this energy and debt squeeze requires a proactive defense. Here are 3 things you can do right now. First, stress test your cash flow. Calculate your fixed monthly expenses and see if your budget can still function if your energy and food costs rise by an additional 20 to 40%. Second, audit your variable debt. Determine exactly how much more your monthly payments will be if interest rates climb another full percentage point. Third, monitor the leading indicators. Keep an eye on the physical to paper oil spread, the 10-year Treasury yield, and the Consumer Sentiment Index. Focusing on these raw numbers will give you more clarity than following the daily market headlines, helping you avoid being harvested by a panic you didn't see coming. The split between Wall Street and the real economy is widening. Those who don't recognize the disconnect risk losing their savings to a silent inflation that is already well underway. For the exact wealth protection blueprints we use to navigate these shifts, join our free stock investment masterclass. The link is right there in the description. This is the Stewardship Finance Academy, sharing financial intelligence you were never taught in school. Like and subscribe, and I'll see you next time.